There's a global market worth $130 trillion that affects everything from your mortgage to your stock portfolio. And that global market is the bond market. Bonds are used by governments, municipalities, and corporations, and we'll dive deeper into what a bond actually is, but understanding bonds will allow you to understand money just a little bit better. So in order to understand what a bond actually is, here is a very easy example. So say I need $10,000 for a home improvement project, but I don't have the money available. So I go to my local bank and they give me a $10,000 loan. They also assign me an interest on that outstanding $10,000. Now that interest depends on my credit score, the loan type, and the overall interest rates in the economy, which is very similar to how bonds work. So the bank ends up assigning me a 10% APR, annual percentage rate, which is my interest that I have to pay the bank annually. And I also have 1 year to pay back that $10,000, which is my maturity. So annually, in order to take out that $10,000, I have to pay the bank $1,000 and pay back that $10,000 to the bank within a year. So in turn for all this, I get my $10,000 to fund the home improvement project. Governments, municipalities, and corporations do the same thing like that example, but they issue bonds to investors. The US government in particular frequently issues bonds, sometimes on a monthly basis, depending on the bond, to raise money for certain projects. As of 2025, the US government made around $5.3 trillion in tax revenue, but their spending was around $7.1 trillion. So that gap is a $1.8 trillion deficit. So they're not actually making a positive net profit. And this is exactly why the US needs to keep issuing new bonds to investors. Okay, so the US government would like to issue money for an important project they want to pursue. So they go to the primary market and issue a bond in an auction. Now the primary market is where many securities are initially offered to the public. And most retail investors can't access the primary market. The primary market is really available for institutional investors, just investors overall with a large amount of capital. But the thing about the primary market is that you can only buy new securities. You cannot sell them. So the US government is looking to issue bonds on the primary market in auction. So they issue the bonds with a par value of $1,000, a coupon rate of 5%, and a maturity of 10 years. The par value is what you initially pay for the bond, and you receive the par value once the bond matures in 10 years. So you get back that $1,000. The coupon rate is the amount of interest you will receive, just like that example with the loan. This stays fixed to your par value no matter what price you paid for the bond. Typically, you will receive interest on a semi-annual basis, depending on the bond, but for most US government bonds, it is semi-annually. So you would receive $50 annually, or $25 in 6 months, and then another $25 in 6 months. But the main thing that affects your mortgage and your stock portfolio doesn't happen in the primary market, it happens in the secondary market. Once the investor buys the bond on the primary market, they can now go and sell that bond to other investors on the secondary market. On the secondary market, investors can buy and sell already issued bonds from other investors. And this is where bond yields come into play, which really control everything. So think of a seesaw. When there's more weight on one side, the seesaw moves to that direction, and when there's more weight on the other side, the seesaw moves in that direction. This is very similar to bond yields. When prices fall, yields rise, and when prices rise, yields fall. So you buy that $1,000 bond with a coupon of 5%. Well, 1 year later, a new set of bonds are issued, and they offer a coupon rate of 10%, making your 5% bond less attractive to investors because they can get a higher coupon payment and higher yield. Investors think, why would I pay $1,000 for $50 per year when I can get $100 per year elsewhere? If you'd like to sell your bond on the secondary market, you would need to offer it at a price lower than your par value. This is what we call selling at a discount. To determine that selling price, you would need to have a yield that is comparable to the newly issued 10% bond. The yield measures the total return that you will get based on what you pay for the bond today. So in order to attract investors to your old bond, you would have to sell at $500, making the yield 10%, which is comparable to the newly issued bond. So the new buyer pays $500 for the bond and still gets their $50 per year because the coupon stays fixed to the initial par value. The investor also gets a capital gain or profit of $500 when the bond matures in 10 years, because no matter what the price paid for the bond, you still receive the original par value. Now it definitely gets more complicated than that, and selling the bond for $500 is a bit extreme, but hopefully you understand the idea of bond yields. Now bond yields are directly affected by many other factors, including inflation, economic growth, interest rates, and supply and demand. All of these factors affect what investors are willing to pay for the bond, and the price affects the yield. So say inflation rises. Investors are thinking that $50 coupon payment is worth less now, and they aren't willing to pay $1,000 for that bond. Investors' required return, or the yield they want, changes, and that's when the price has to adjust. So just like the example, when comparing a newly issued bond with a higher coupon rate, in order for you to sell this bond with the high inflation, you would have to offer it at a discount, a price below the $1,000, making the yield for your bond rise. Now, how does all of this connect and affect your stock portfolio and home prices? Well, everything starts with the 10-year U.S. Treasury yield. This yield is considered the risk-free rate and is used by financial institutions, banks, and investors. In order for banks to determine mortgage rates, they will use the yield from the 10-year Treasury bonds. So it's 10-year Treasury bond yield plus the spread, which equals the mortgage rates. The extra spread is used in case of customers not paying their mortgage and to increase profit margins for banks. So if bond yields rise, mortgage rates increases, and if bond yields decline, mortgage rates decrease. Higher mortgage rates decrease demand for homes because of the higher cost associated with purchasing a home, and this decrease in demand decreases home prices. Now, lower mortgage rates increases demand because more people can afford purchasing a home. It costs less to take out that mortgage. So an increase in demand for home prices, which in turn then increases the price because there's more competition. So now you know how bond yields, or just bonds in general, affect home prices, but how does it affect the stock market? And most importantly, how does it affect your stock portfolio? Well, first, bonds are direct competitors to stock. It primarily comes down to risk and return. Bonds tend to be a less risky asset than owning a stock, and with more risk comes a higher potential return. Lower risk, lower potential return. So if bond yields rise, investors could potentially get a higher return from bonds than stocks. So investors are investing more in bonds than stocks. They're taking out their money from the stock market, which creates a bearish sell-off or the stock price to come down. And vice versa. If bond yields go down, then bond investors may take out their money from bonds and put it into the stock market, which could increase the stock price. It also just comes down to the overall economy and whatever's happening geopolitically. If investors think that the economy is starting to slow down, or we are invading another country, or war is beginning to happen, stocks most of the time get hit the hardest. And with bonds, you can invest in them and get a fixed return over a set period of time. It could either be short-term or long-term. So more investors may want to take their money out of the stock market and put it into bonds, which could decline the stock price. Now, bond yields also affect stock valuation. A lot of time, the risk-free rate, like I explained earlier, that U.S. Treasury 10-year yield is used for stock valuation, which could also affect stock prices. But that's for another video. So that's how this $130 trillion market affects your stock portfolio, home prices, and even your mortgage. If you have any questions, drop them down in the comments and I'll try my best to answer them. I hope you enjoyed this week's episode. I upload videos every week, so stay tuned for the next episode next week.